The U.S. economy is, as you know, struggling to recover with the job market stagnant, oil gushing out of the Gulf. But a new Bloomberg survey found that the U.S. has now taken over China and Brazil as the most attractive market for investors. The manager of the world's biggest bond fund, PIMCO's Bill Gross, even says it's all based on perspective and that the U.S. has the least dirty shirt as confidence shrinks around the world. So it's not surprising that investors have been pouring into U.S. Treasuries this year. For an update on the bond market, we're pleased to be joined by William O'Donnell, head of U.S. Treasury strategy at RBS Securities. In the past, he's been named All-American Strategist by Institutional Investor. Bill, great to see you.
Well, thanks for having me.
So would you agree that the U.S. is the preferred safe haven for investors at these days?
Oh, absolutely. And there's no greater illustration of that than today's $36 billion three-year Treasury auction. And that auction came off at 1 o'clock, and the rate that the auction came at 1.220%, is just 2 basis points above the all-time lowest ever three-year auction award at 1.20% back in January of '09. So still an impressive amount of money flowing into U.S. dollars and in particular into the Treasury market.
Now, would you expect this continued flight to safety into U.S. Treasuries until the credit crisis in Europe is settled or contained, or however you want to characterize it? Not a threat to markets anymore.
Yeah, if you look at the long history of credit cycles and sovereign delevering, these are not events, they're processes. They take years. And to the extent that the market has become alerted to the issues with excessive levels of sovereign, and I would even argue household debt in the United States and Spain and the UK, for example, these are years of accumulated debt that have to be wound down through fiscal austerity. And I think now the market sniffs that out. They see a lower growth path ahead, and as a result, they're pouring into the Treasury market, which is a very liquid, of course, and safe market.
Now, given the financial scenario you're outlining for us, global economic conditions, I mean, is it fair to say rates are going to stay, not even just here in the U.S., but globally, going to stay low for a while?
That certainly is our belief. And just to the market that I focus on, the Treasury market, Dom was talking about 10-year yields being at the low end of the one-year range, roughly defined as 401% to 306, I think was an intraday low we hit on May 25th in 10-year yields. My best guess is we're going to stay near the low 3% level, and if we move anywhere here in the next 3 months, it's likely to be below 3% in 10-year yields as disinflationary forces persist and people get more concerned about waning fiscal stimulus and increasing credit restraint.
Now, Bill, it's Dominic Chu here. Just I remember we were on the phone, maybe it was the beginning of April, and yields on the 10-year were literally at just above 4%. And all of a sudden, we were on the phone, and you said, you know, Asian investors swooped in and said we saw a 4% yield, we had to buy those bonds.
Yes.
So can we continue to see international demand for these securities, especially the 10-year?
Yes, and we have a 10-year auction tomorrow and a 30-year auction on Thursday. These will be a very important acid test to the market because one of the themes that we've been seeing from investors is people not necessarily pouring new cash into the market, but at the same time moving cash out the curve in search of yield. You have to go almost all the way to 2018 paper or 8-year paper to get a 3% handle or a 3% rate. And people are just sitting in 2-year notes at 70, 0.75% and saying, I got to move out the curve. And I'm not that concerned about inflation, so I'll buy 5s, or 5-year owners move out to 10s. So we are seeing flows out the curve, and I think this is a trend that could persist with a flatter yield curve in the coming months.
So, Bill, let me ask you this, getting back to the auction and this flood of supply, when is too much going to be too much? I mean, there's so much Treasury supply out there, correct?
Well, there is, two things on that point. First of all, you have to look at Treasury supply, which is just a slice of total domestic borrowing. And if you include household, business, and financial sector borrowing, those have collapsed in GDP terms, even though Treasury borrowing has risen. So when you look at the whole pie, yes, Treasury borrowing is a larger slice of the pie, but the pie itself is actually shrinking. So there's just not a lot of supply in total out there, and that's something you have to keep, investors should keep in mind. The second thing to consider is Treasury has begun to cut coupon supply. Today's 3-year auction was $36 billion. The auction in April was $40 billion, and it had been there for a number of months. So the supply is already down, at least in 3-year notes, 10% from levels 2 months ago, and is likely to continue to go lower as budget metrics improve somewhat.
Okay, maybe another bearish argument for bonds, just to play devil's advocate. The Federal Reserve Chairman, Ben Bernanke, coming out saying that the recovery is intact.
Yeah, but he also said, I mean, there's always an asterisk to a lot of the positives that the Fed seems to come forth with. They're very concerned about the headwinds. They're watching very closely what's going on with the debt crisis in Europe. And by the same token, we've got significant problems at home. We have this, we have a deficit that the Fed acknowledges way too high and unsustainably high. There are problems at the state level, so we have fiscal austerity, not just at the federal level, probably some months ahead, but at the state level, certainly ongoing right now.
Okay, thanks.
So the stress continues.
I just wanted to ask you, Bill, we have about 45 seconds left. The best strategy for investing in Treasuries right now?
Well, I'll tell you what, I like long-end Treasuries. We think it's going to be a long time before the Fed considers raising the benchmark rate. We think it's going to be a very difficult haul to get this economy not just to a sustained and robust recovery, but at the same time the unemployment rate down to a level that will force those rate hikes. So we like long-end Treasuries. We think on any backup, 3.25%, 3.5% in 10-year yields that investors should buy those.
Appreciate your insight. Bill O'Donnell is the head of U.S. Treasury strategy at RBS Securities. Thanks again for your time.
Thank you for having me.